Ask 10 people whether real estate or stocks is the better investment, and you will get 10 different answers, usually delivered with total confidence. The real estate camp will tell you that property is tangible, that you can leverage it, that tenants pay your mortgage while the asset appreciates. The stock market camp will tell you that equities outperform everything over the long run, that they require no maintenance, no tenants, and no midnight phone calls about a broken boiler. Both sides sound convincing. Both sides are citing real advantages. And both sides are leaving out critical parts of the math that would completely change the conclusion. So today we are not doing opinions. We are doing the actual numbers, the real math on what each investment vehicle produces, what it truly costs, and which one actually builds more wealth over time. My name is Tomas, and this channel is about finance, automation, and wealth-building strategies backed by evidence and real numbers. If you are new here, welcome. Hit that like button right now and subscribe so you never miss a video. Today, we are running the real math on real estate versus stocks, side by side, honestly without the bias, so you can finally make this decision with clarity. Let's get into it. Before we run the numbers, let us establish the rules of the comparison, because this debate goes wrong almost every time it is had, and it goes wrong for the same reason, why most real estate versus stocks comparisons are completely misleading. The biggest mistake people make when comparing these two asset classes is that they compare the gross return on real estate, the total appreciation of the property value, against the net return on stocks. They say the house went from $200,000 to $400,000 in 15 years. That is 100% return. And they compare that to a stock portfolio that returned the same amount or slightly less. Conclusion: real estate wins. But that comparison ignores almost everything that matters. It ignores the mortgage interest paid over 15 years. It ignores property taxes paid annually. It ignores maintenance and repair costs. It ignores insurance. It ignores the opportunity cost of the down payment sitting in an illiquid asset. It ignores vacancy periods if it was a rental. Once all of those real costs are included in the calculation, the picture looks dramatically different. And that is why we have to look at actual net returns, what the investor actually walked away with, on both sides. The stock market case, what the numbers actually show. The historical long-term return of the S&P 500, including dividends reinvested, has averaged approximately 10% per year in nominal terms, and roughly 7% per year after adjusting for inflation. That is an extraordinarily consistent long-run average across more than a century of data, through world wars, recessions, financial crises, and pandemics. Here is what that means in real dollar terms. If you invested $100,000 in a broad S&P 500 index fund 20 years ago and simply held it without touching it, reinvesting dividends automatically, you would have somewhere in the range of $600,000 to $700,000 today, depending on the exact start and end dates. You paid no mortgage, no property taxes, no maintenance bills, no insurance premiums beyond what you already pay for your life. The investment required nothing from you except the decision to hold. The cost structure of stock market investing in 2027 is also astonishingly low. A broad market index ETF with an expense ratio of 0.03% charges you $3 per year on every $100,000 invested. That is the entire annual cost. No transaction fees at most major brokerages. No management overhead. No unexpected expenses. The return you see reported is very close to the return you actually receive, which is a rare thing in the world of investing, and the liquidity of stocks is a genuine, underappreciated advantage. If you need $50,000 from your stock portfolio at any point, you can have it within days, with no transaction costs, no legal process, and no impact on the rest of your holdings. Try doing that with a rental property, and you will quickly understand why liquidity matters. The real estate case, including leverage, cash flow, and what most analyses miss. Now let us look at real estate with equal honesty, including the advantages that stock market comparisons routinely understate. The most powerful feature of real estate investing that has no equivalent in the stock market is leverage. When you buy a property with a 20% down payment, you are controlling a 100% asset with 20% of your own money. If that property appreciates in value by 10%, your actual return on the cash you invested is not 10%, it is 50%. Because the appreciation applies to the full value of the property while only your down payment was at risk. Let us run that math concretely. You purchase a $250,000 rental property with a $50,000 down payment. Over 5 years, the property appreciates to $325,000, a 30% increase in property value. Your $50,000 investment has generated $75,000 in equity appreciation alone, before accounting for any rental income received. That is a 150% return on the cash invested, driven entirely by leverage. The stock market would need to return 150% over the same period to match that on a cash invested basis. It rarely does. But now we have to add the real costs back in. On a $250,000 property with a 30-year mortgage at a 6% interest rate, you are paying roughly $1,200 per month in principal and interest. Property taxes at an average effective rate of 1.1% nationally add roughly $230 per month. Insurance adds approximately $100 to $150 per month. Maintenance and repairs on a rental property typically run between 1 and 2% of the property value annually. That is another $200 to $400 per month in reserves you need to set aside. Vacancy periods, even in a strong rental market, average 5 to 10% of potential annual income that never arrives. When all of those costs are totaled and subtracted from the rental income and the appreciation, the actual net annual return on a well-managed rental property typically falls somewhere between 6 and 10%, similar to the long-run stock market return, but requiring dramatically more time, attention, management skill, and tolerance for risk concentration in a single illiquid asset. The tax picture, where real estate pulls significantly ahead. Here is where the comparison genuinely shifts in real estate's favor, and it is a shift that stock market advocates frequently underestimate. Real estate comes with a set of tax advantages that have no parallel in stock investing. Depreciation is the most powerful of these. The IRS allows residential rental property to be depreciated over 27.5 years. That means every year you can deduct a portion of the property's value as a paper loss against your rental income, even if the property is actually appreciating. This deduction can dramatically reduce or even eliminate the taxable income generated by a rental property, allowing cash flow to be received largely or entirely tax-free in many situations. When you sell a property, a strategy called the 1031 exchange, named after Section 1031 of the tax code, allows you to defer capital gains taxes indefinitely by rolling the proceeds into another qualifying investment property. This deferral, repeated over a career of real estate investing, can allow wealth to compound for decades without the tax drag that affects stock market investors selling appreciated positions in taxable accounts. Stocks have their own tax advantages, particularly in tax-advantaged accounts like Roth IRAs, where growth is completely tax-free. But in taxable accounts, capital gains taxes apply when appreciated positions are sold, and dividend income is taxable annually. For investors in higher income brackets, the real estate tax structure can produce meaningfully better after-tax returns even when the gross returns are similar. So which one actually wins? The honest answer, the one that the real math actually supports, is that neither one universally wins. What determines the outcome is not the asset class. It is the individual investor, their specific situation, and how well they execute their chosen strategy. Real estate outperforms when the investor has the skills, time, and temperament to manage properties effectively, access to good markets with favorable price-to-rent ratios, the ability to use leverage responsibly, and the sophistication to take full advantage of the tax benefits available. In those conditions, real estate can produce returns that stock market investing simply cannot match. Stocks outperform when the investor values simplicity, liquidity, and low ongoing management burden. When they invest consistently over long periods in low-cost index funds, reinvest dividends, and hold through volatility without panic selling. In those conditions, which are achievable by almost anyone, the stock market delivers exceptional long-term returns with a fraction of the complexity. The most financially successful people tend not to choose between the two. They build stock market wealth first, using the simplicity and low barriers to entry of index fund investing, and then add real estate when they have the capital, knowledge, and bandwidth to manage it well. The combination of both, equity compounding in the market and leveraged appreciation in real estate, is the foundation of more millionaire net worth statements than almost any other strategy in existence. The real math does not declare a winner, it declares a framework. Match the asset to your skills, your time, your temperament, and your tax situation. Execute consistently, and let compound growth do the rest. So there is the real math. No bias, no cheerleading, just the actual numbers on both sides. Stocks deliver roughly 7 to 10% annualized returns historically, with almost no management burden, extraordinary liquidity, and costs so low they are nearly invisible. Real estate delivers comparable gross returns, but with the powerful amplifier of leverage, a tax structure that can dramatically improve after-tax outcomes, and cash flow that stocks simply do not produce, at the cost of significant time, management complexity, and capital concentration in an illiquid asset. Neither one wins universally. Both can build extraordinary wealth when executed correctly, and the investors who build the most wealth are almost always the ones who use both, starting with the simplicity of index funds and adding real estate when the skills and capital are in place to do it right. Run your own math, know your own situation, and build accordingly. If this video gave you the clarity to finally make this decision confidently, please hit that like button. It genuinely helps this channel grow. And if you are not subscribed yet, click that button right now so you never miss what is coming next. See you in the next one.